$1 million in Bitcoin is not too far away. Maybe the halving cycle is dead, but it doesn't mean that we will see diminishing returns in the future. To the contrary.
It definitely seems like this is the catalyst. Like this is what's going to push this market forward for this cycle.
We'll probably see a re-acceleration, right? We'll probably see increasing returns, not diminishing returns. Our official prediction at Bitwise is...
Hello, everybody. Thank you for joining us for this special podcast with Andre Dragosch, the head of research for Bitwise in Europe. Andre, thank you so much for joining us.
Thank you so much, Rob. Yeah, thanks for having me.
Yes, very excited for today's conversation. You are a on-chain expert. You are looking at what's going on in Bitcoin from an analytical point of view every single day. You are deep in the weeds, and I think you'll be able to give our audience a nice, clear explanation of what is really happening in Bitcoin at this pretty pivotal moment. So as we take a look at the landscape today, we had Trump come in, we had markets explode before he was in office, and then he starts talking about tariffs. Things crash. We see an actual technical bear market in the S&P, and Bitcoin crashed down to 75,000, of course, but now we're right back up. We're over 100K. And you put out some posts about how Bitcoin performed in comparison to the stock markets during this time of turmoil. So have we actually decoupled, or is this a fabrication?
It's probably the question of questions, right? I think we've been talking about real decoupling probably for a couple of years, right? That the coupling is imminent and so on, right? Because Bitcoin is being increasingly regarded as safe haven asset and not as risky asset. And I think the truth is, if you look at Bitcoin's risk profile, if you look at Bitcoin's volatility over time, right, it's been trending down, right, since the beginning, essentially, right. So if you look at, for instance, 2012, annualized volatility has been around 200%, right? So it's been like a Speedy Gonzalez kind of risky asset, very risky asset, right, in comparison to US equities. But over time, I think with increasing adoption and increasing scarcity induced by the halvings, right, we've seen that there's been a structural downtrend in volatility. And lately, realized volatility has actually decreased below the Mag 7 stocks like Tesla, Nvidia, and so on, right? Which is, it's like a first timer, right? And but I think before 2025, we haven't really seen significant decouplings, right, between Bitcoin and equities, right? And this time, I think we've really seen the first real decoupling, and we can talk about the reasons why. But I think the overarching theme and the big picture is, so Bitcoin's character is changing, Bitcoin's risk profile is changing, the volatility is trending down. It's becoming increasingly more like a safe haven asset and not so much like a risky asset. And now we're seeing, I think, the first signs of this transition, from a risky asset into a safe haven asset. I think we just had one episode before, but it wasn't really a real decoupling. It was during the SVB saga, right? And I think it was February 2023, right? When we had these banking problems and Silicon Valley Bank collapsed, right? And intraday, you didn't really saw decoupling, but you saw swifter recovery in Bitcoin compared to US equities, right? So Bitcoin was immediately bought, right, while US equities still suffered, right? And I think it's during these periods of increasing systemic risks, like such as banking risks, or like I think in April it was sovereign US Treasury risks, right? That you start to see this kind of decoupling, between Bitcoin and traditional assets like equities.
Yeah, so it definitely shows these flashes during these times of crisis, right? Where it's sort of the first mover, the thing to show that we are, you could say, getting out of it, right? I mean, the Bitcoin led the charge of the recovery post that regional banking crisis, and now it seems to have led the charge in the recovery of whatever we're seeing right now. So do you think that it actually will break away, or is it just leading the charge of the equity markets, or will it actually, is it showing signs of breaking away and truly decoupling?
So what we saw historically, if you look at the data itself and you look at correlations, right? For instance, just like 90-day rolling correlation or 60-day rolling correlations between Bitcoin and the S&P 500, it's still positively correlated. We just saw a decline in intraday correlations. And the thing about Bitcoin is it's not yet a downside hedge, right? If you look at down days itself, at least as far as equities are concerned, the S&P 500, for instance, you can see that on average, gold is a better downside hedge for US equity downside than Bitcoin is, right? That's at least what the data says. But if you look at US Treasury down days, and I think that's, we called it the Bitcoin bond conundrum, because it's somewhat a conundrum, because I mean, Bitcoin is supposed to be a risky asset, but at the same time, you can see it has better hedging qualities for US Treasuries, which are supposed to be a safe haven asset, but of course they're not anymore, right? But they're supposed to be a safe haven asset, and during these down days, at least historically, Bitcoin has provided a better hedge than gold, which is somewhat incredible. So we call this the Bitcoin bond conundrum. But like the fact is, in more than 50% of the cases, when US Treasuries had a negative daily performance, Bitcoin was up. It had a positive performance. Gold had less than 50% of the cases, you know. And so in general, you can say gold, at least for now, right? Historically, gold has been a better hedge against equity downside, right? Against risky asset down, like, yeah, classical beta, market beta. But at the same time, Bitcoin has been a better hedge against US Treasury downsides, right? And I think it's really remarkable. And it goes a long way, or it plays so much into this narrative that Bitcoin might be a volatile asset, right? It has lots of market risk, right? But it doesn't have so much counterparty risk. And if you're talking about bond investments, right? I mean, your returns around, I don't know, 4 or 5% annually, right? You don't care so much about return, obviously, right? You care much more about counterparty risk, that your money is safe, right? And I think in this regard, and especially in the context of Bitcoin being the new kind of reserve asset, this is how I think Bitcoin has to be looked at. Not so much, okay, it's decoupling from equities, right? It's a hedge against equity downside risks. I think the reason why Bitcoin decoupled from equities had to do with troubles in the bond market rather than troubles in the equity market.
Yeah, and we'll dive deeper into the troubles in the bond market later on in this conversation. But before we get there, I want to talk about this cycle in general, right? Mm-hmm. And tell me where you like to draw the lines for these cycles. Do you start looking at them between halvings, from bottoms? And how would you say that this cycle is playing out differently from the one that we saw in 2020?
I think you have more institutional adoption, obviously, especially as far as corporations are concerned, publicly listed companies, right? So yeah, I think you have more diffusion of companies that are buying Bitcoin or that are adopting a Bitcoin standard, right? So that has definitely changed, and you can see it in the data. It's incredible. The growth in Bitcoin holdings on corporate balance sheets is, I think, unprecedented, right? I mean, 2024 was a big year for corporations, but I think we're already close to surpassing this kind of buying in 2024 already, and we're only in May. So the amount of buying is incredible. It's unprecedented. But I think in terms of cycle, I think the big debate on Bitcoin Twitter, I think in general, is like, is the 4-year cycle dead, right? Do we still see this kind of catch up in post-halving performance? Because we've been trailing previous halving performances, right? I mean, if you look at the last three halvings, so 2012, 2016, and 2020, I think the average performance post halving, right, was 17x, right? I think around 500 days after the halving, and we haven't even done like 2x, right? Because the halving price in April 2020 was 64k, and we're now trading at around close to 100k, right? So we haven't even done 2x, right? So we're trailing previous post-halving performances, right? And so I think it's a legitimate question that you say, like, that you ask, like, is the 4-year cycle dead, right? And I think what is true in this context is, I mean, the halving, the supply deficit induced by the halving has decreased over time, right? It used to be, I think, 12.5% of the supply deficit itself in the first halving, right? When we had the supply deficit of 25 Bitcoins per block induced by the halving, right? And the latest halving has only induced a supply deficit, I think, of less than 1%, right? So in relation to the existing supply, right, the supply shock, the supply deficit has become smaller and smaller over time, right? And it must, I mean, it has to lead to diminishing returns, right, of the halving itself. But that being said, right, I think what you're still seeing is you see this decline in exchange balances, but I think it's probably related to the halving and reduced miner output. But at the same time, I mean, it's not so much a supply shock anymore. I think it's rather a demand shock, right? And I think if you look at the latest numbers, if you look at the amount of MicroStrategy buying, right, this year and last year, I mean, the amount of buying by corporations is already bigger than the halving effect, the annual halving effect. So I think it's rather a demand. We have to start talking about a demand shock, right? A demand overhang, not so much supply. It's also supply deficit, but it's like different side of the same coin, right? But yeah, I think we are slowly transitioning from this halving effect, like supply deficit, which is becoming smaller and smaller over time, to this increasing demand shock, in my view. And if you assume that there's always this talk about hyper Bitcoinization, right? And that we're like crossing this chasm from early adopters to early majority, where at least theoretically you start seeing exponential growth of adoption, right? Meaning exponential growth of demand, right? So if you assume this theory to be true, right, then corporate demand, ETF demand, institutional demand in general, retail demand, right, should accelerate, right, from here. That means probably the halving effect is becoming less relevant over time, right? But at the same time, this kind of demand effect is becoming more relevant. But the interesting implication is that maybe the halving cycle is dead, right? But probably it doesn't mean that we will see diminishing returns in the future. To the contrary, we'll probably see a re-acceleration, right? We'll probably see increasing returns, not diminishing returns, if we really start seeing this kind of exponential growth, right?
Mm-hmm. Yeah, that was my next question. Like, does the fact that we see the diminishing returns of the supply effect with the halvings, does that mean that diminishing returns in price are going to be here from now on? Or are we sort of at the middle of this S curve where the baton gets handed off from the supply shock to the demand shock? And so do you think that we could see that in Bitcoin, just like a phase shift in price where one week, one quarter, we're just in a different zip code than where we are right now with Bitcoin? Do you think that's on the table, or is it just going to be a slow grind up from here to $1 million plus?
I think $1 million in Bitcoin is not too far away. As I think In fact, our official prediction at Bitwise is we'll reach $1 million by 2029. That's not too far away, right? It's like, so we 10x within the next 4 years, right? That's our official prediction. And the rationale behind this is Bitcoin will start being a serious alternative reserve asset, right? It will match gold's market cap. And when we made this prediction in December 2024, gold was much lower, right? But so this led us to the prediction that if Bitcoin matches gold's market cap, we'll end up at $1 million per coin. But it's actually still conservative, because Bitcoin's not only competing against gold, right, in terms of reserve asset. Gold's like the old legacy reserve asset, the pre-1971 reserve asset. I mean, there's a new trend towards gold as a next reserve asset again, right? The share in international reserves increasing. I think gold has surpassed the euro as the second biggest reserve asset again, right? Next to the dollar. So the dollar's still on top, but gold second again, right? So there's a new trend, especially among emerging market central banks, right, to accumulate gold. But I think Bitcoin's also competing against the new reserve asset, which are US Treasury bonds, right? And Bitcoin, gold's market cap's around $22 trillion right now, right? Which implies, I think, $1.1 million per Bitcoin if Bitcoin matched the gold's market cap. But if you look at the treasury market, it's huge. It's like $28.5 trillion, right? So if Bitcoin disrupted US treasuries as a reserve asset, hypothetically speaking, of course, but let's say Bitcoin disrupted US treasuries, then Bitcoin's price would increase to 1.5 million per coin, right? If it disrupted both gold and US treasuries, right? You have to sum up these numbers, right? That means in excess of 2 million per coin is eventually, right? And I think that's the trajectory we are moving towards, over the long term. But I think Bitcoin doesn't even have to disrupt gold, meaning, okay, gold becomes irrelevant or US treasuries become irrelevant. It just needs to match the market cap, right? It just needs to stand side by side, right? To gold or US treasuries as an alternative reserve asset, right? And so I think it's a very likely scenario that we at least match the market cap, right?
And so when Bitwise comes out with a prediction like $1 million gold or $1 million Bitcoin by 2029, what is the process to come to that conclusion? Because it's not just somebody on Twitter who comes out and says Bitcoin's going to 1 million in a year. You're a large institutional firm, and when you put out a price target of 1 million in 4 years, that carries some weight behind it. So behind the scenes, how is that come to conclusion, and what's the process behind that?
It's actually quite democratic. So we have Google Sheet, people put in all kinds of predictions, right? Because we put out these top 10 predictions, right, at the end of each year for next year, right? And so the way we do this is we start collecting our top predictions, individual predictions internally among research, but also other people who want to be involved, And then we start voting on them, What do you think is the best prediction, or what do you think from from a marketing point of view, what's most interesting? Because you don't want to do a niche kind of prediction that no one cares about, right? And so we collect them, and then we have a discussion about price targets as well. And I think if you look at different kinds of models, right, for Bitcoin, 1 million is not too far-fetched, right? The power law, which is quite conservative, it's a quite conservative model, which also forecasts diminishing returns over time. But still, even the power law, I think in the year 2032, you arrive at $1 million per coin, right? So I think it's quite likely that we see at least around the turn of the decade, $1 million per coin. If you look at different kinds of quantitative models, if you look at I've just mentioned the power law, right? But if you look at like things like the Bitcoin or autocorrelated exchange rate model, the VERM model, which is some kind of halving supply shock model, it's also quite conservative because it also implies diminishing returns of the halving itself, right? Stock to flow, we don't need to talk about it, it's way higher, right? So all in all, I think even like quantitative informed predictions, they tell you, okay, 1 million Bitcoin is not imminent, but like I think over the course of the next 5 years, it's quite likely.
I wanted to briefly interrupt today's interview to give a big shout out to our lead sponsor, Rhino Bitcoin. Rhino is the all-in-one Bitcoin super app built by Bitcoiners for Bitcoiners. Buy or sell instantly. Send sats anywhere on the Lightning Network. Withdraw straight to cold storage. Even turn sats into gift cards or link to a Casa multisig, all within one sleek interface. And Rhino is just warming up. Soon, you'll pay bills, borrow against your Bitcoin, and save for retirement, all without leaving the app. Download Rhino at rhinobitcoin.com or tap the link in the description below. Use promo code Bitcoin News and Rhino will drop you $10 of free Bitcoin into your account today. Secure your stack with Rhino Bitcoin and enjoy the rest of the video. And so since you're so deep into the metrics and the models, what do you think is a particular metric or model that the average Bitcoiner can use to help guide them on their journey to get a better sense of the market or to help orange pill people in their life?
I've just been to a retail conference, in Germany. Was like, it's the biggest retail conference. It happens annually in Stuttgart in the south of Germany, and it's a huge conference. We had like I think 15,000 participants, but mostly retail. And I think the best way to orange pill no coiners is to give them some kind of reference, right? I think this kind of relative market cap model is a good way to explain this narrative, to explain like, okay, Bitcoin is increasingly being regarded as an alternative reserve asset, right? It's probably disrupting gold, or it's quite likely that it's disrupting gold because it's technologically superior, right? We know it has it's better in terms of transferability, it's better divisibility, verifiability, and so on, right? So you can start using this kind of narrative, right? And also these explanations with like gold's relative market cap, US Treasury market cap, I think even to explain it to no coiners. I think the investment case, because we at Bitwise, we don't only offer Bitcoin ETPs, right? Bitcoin is still our biggest product and most important one, but at the same time, of course, we talk about Ethereum, Solana with other investors. I think other crypto assets are harder to explain, right? But I think the best narrative for Bitcoin, especially for retail investors, no coiners, let's say, it's like this market cap thing in this transition. And that's, I think, why investors need to allocate, right? Because if it's disrupting or if it's threatening to disrupt the prime reserve assets, gold and US treasuries, then you have a problem if you, for instance, if you own a lot of gold or if you own a lot of bonds, right?
Yeah, and speaking of disrupting gold, you are finishing up a book right now called Exponential Gold.
Yes.
About Bitcoin. Yeah. So tell us about the process of writing the book and who's it for?
So yes, the reason why I came up with Exponential Gold is, my day-to-day is I write research reports, of course, right? But we also do client meetings, conferences, and so on. And we talk about the investment case for Bitcoin. We talk about portfolio allocations, right? How to allocate, and so on. And so I had this need just to write down everything I know, right, about Bitcoin and also other crypto assets, and provides like an investment guide, asset allocation guide to Bitcoin and other crypto assets, how to allocate wisely, how to understand Bitcoin, how to understand money itself, right? Because I think in order to understand Bitcoin and the utility of Bitcoin, you need to understand the monetary system, which is complicated enough, right? That you need to understand money first before understanding Bitcoin and the utility, and then the valuation case of Bitcoin, the investment case of Bitcoin, how to allocate, right? What's the difference between Bitcoin and other crypto assets, and so on. So, and you mentioned exponential gold, and the reason why I call it exponential gold is I think it's between Bitcoin's in between the intersection of absolute scarcity, right? Like gold is even scarcer than gold, obviously, right? Absolute scarcity and exponential growth of adoption, right? And you just mentioned that we're probably passing the baton from this halving effect, right? The supply deficit, supply shock, to like increasing adoption, increasing demand, exponential demand. And I think Bitcoin is at this intersection. And personally, that's why I don't believe in diminishing returns, personally. I think the 4-year cycle is probably not dead, right? But I think because we still have some overlap between US business cycles, right, that also happen every 4 years. We had business cycle troughs in 2012, 2016, 2020, COVID, and so on, to COVID recession. Now we probably have a new business cycle trough in 2025, right, in the US. US presidential election cycles also 2012, 2016, 2020, 2024. And so I think the jury is still out there whether the 4-year cycle is dead, but I think it looks increasingly likely that we don't have diminishing returns, which is probably more important, right? Anyway, right? Will we see like decreasing performance on average, or will we see increasing performance on average? I think that's the biggest question, right? And I think for me personally, when looking at the data, when looking at how institutional adoption will evolve because of declining volatility of Bitcoin, and so increasing allocations to Bitcoin as well, right? Because it has less risk contribution and so on. I think we are rather looking at this kind of exponential growth.
Yeah, and let's talk about that. You brought up the fact that you think that the corporate adoption of Bitcoin is more important for hyper-Bitcoinization than the ETFs were. And so, I mean, the BlackRock ETF was the most successful launch of any ETF in history, right? Cumulatively, I think all 9 of them in America have had inflows of over $40 billion. They just hit a new all-time high, right? So this was an outstanding success. But now we're seeing this explosion of corporations adopting Bitcoin. And these are all different kinds, of course, going from the gorilla in the room MicroStrategy down to the Semler Scientifics and the Metaplanets of the world, and now all these new ones too, right? From big ones like 21 with Jack Mallers to David Bailey's Nakamoto, Kindly, whatever they're doing there. But I mean, it's a massive explosion happening right before our very eyes, and it definitely seems like this is the catalyst. Like this is what's going to push this market forward for this cycle. So take us through your reasoning as to whether you think that this is a good thing, a great thing, or will it lead to the next bear market?
I think it's a good thing, and it's a good thing because I mean, even if it was a bad thing, right, we can't really stop it, right? Because I think adoption of Bitcoin is inevitable, right? It's like it's Saifedean Samou's saying, like Bitcoin will be adopted like gunpowder, right? If you don't own it, if you don't adopt it, you'll be its victim. So, I mean, it's smart. It's a smart move for corporations. I mean, Bitcoin works because of economic incentives, and corporations, they're incentivized to adopt Bitcoin because of shareholder value maximization, right? Shareholders benefit from a corporate treasury standard, right? Bitcoin standard, because obviously corporations hold a lot of cash balances, right? And they're exposed to an erosion of purchasing power because of inflation, right? And this is suboptimal. And they always hold some kind of structural cash balance anyway, right? It's not like it's fluctuating a lot. They always hold a liquidity pool. And I think the discussion is more about, okay, let's allocate part of this cash into Bitcoin. It's not like we're going 100% on a Bitcoin standard. Probably in the future it will be possible, right? But it's more like we'll allocate parts of this cash balance, fiat cash balance, right, into Bitcoin. And we've seen that it's obviously more beneficial for shareholders, right? If you look at the performance of MetaPlanet in 2024 alone, it's like through the roof, right? It's like 2,700%. And this is just, yeah, I mean, they've adopted the Bitcoin standard in April 2024, right? And they've been by far the best performing equity in the topics, right, in the Japanese market. So, so I think, so you ask, is it a good thing? I think it's a good thing because, like, in terms of hyper Bitcoinization, you instantly onboard thousands of shareholders, right? And I mean, those who don't want to participate, who think, okay, it's a dumb strategy, right? It doesn't make sense from a business idea. Why are they not coding software, or why are they not, I don't know, producing medical equipment, right? Instead, I'll dump the stock, I exit, right? But in fact, many shareholders, they stay because they see the performance. They've been skeptical before this adoption, right? But now they're thinking, oh, maybe there's something to it, makes sense, right? They're doing their research. And in fact, they've indirectly become Bitcoiners. So it's like an instant onboarding of thousands of investors, and the ETPs, they need much more time for this, right? If you look at like the typical ETP, ETF launch process, right? You have some seed money in there, so there's essentially one investor in there. And of course, then you have like pension funds buying in, which also implies indirect ownership, right? So you also have like increasing adoption. But I think it's the multiplier is even more significant if corporations adopt Bitcoin, because so you have this flywheel that like they buy Bitcoin, their stock price increase. Then, for instance, like in the case of Coinbase or MicroStrategy itself, they are included in an index, right? They're included in the S&P 500, and suddenly you have this flywheel that passive index funds or ETFs need to buy into the stock, right? And suddenly all passive S&P 500 ETF investors are also MicroStrategy investors, right? Or Coinbase investors, right? And they are indirectly becoming Bitcoiners. And so, I think that's why it's so significant. And obviously the economic rationale is stock price increase. And but I think it's a huge source of demand, at least in 2025. If you compare to other sources of demand, institutional demand, like governments or ETFs or ETPs, right? It's not even close, right? Everybody thought, I think at the beginning of 2025, everybody thought like, oh, US government's going to buy Bitcoin, right? Because of Trump. We haven't seen anything so far. We have seen Arizona and New Hampshire adopting like Bitcoin as a reserve asset. But still, right, we haven't seen any kind of buying yet from the US government. But like I think corporations surprised many analysts positively, including myself, right? And it looks like it's been accelerating, right? It looks like every time I open my Twitter timeline, it's like, this company adopted Bitcoin standard, or that company just raised more money to buy even more Bitcoin, right? Mm-hmm. And of course you see like the green dots by Saylor on a Sunday, and then like, he smash buys another, I don't know, 10K Bitcoin, right? Almost every week. And so I think it looks like this is accelerating. If we look at the specific numbers, it's like publicly listed companies alone, and I've just tweeted about this like a couple of before the show, right before our conversation. they've bought around 196,000 bitcoins, which is like 3.3 times the amount of new supply, right? Mine supply. And it's already exceeding the estimated annual amount of new supply, right? Which is around 160,000, right? So in a matter of like not even 5 whole months, corporations bought a multiple of new supply, right? And it exceeds ETF buying by, I think, also a factor of 3 or 4 times, right? It's insane.
So when we compare these corporate holders versus ETF holders, I mean, when it comes to Michael Saylor and Michael Strategy, if they sell a single Bitcoin, then their whole entire narrative is sort of flipped on its head, right? But I don't think we can expect all these corporations who do buy Bitcoin to hold on to it as well as he does. And the ETFs, I think those holders have shown some resilience and the ability to hold on, but they also did dump during the market dump that we saw a couple of weeks ago, right? So as you see this play out over the next year, 18 months or so, who do you think will have the stronger hands and be more hardcore holders like the rest of us?
It's probably more corporations because, as you've mentioned, during the market mayhem, right, in March and April, we saw significant net outflows from global Bitcoin ETPs, right, including US spot Bitcoin ETFs. But we didn't saw so much selling from corporations. In fact, we didn't see any kind of selling, right, from publicly listed corporations. So, and I mean, Saylor has been saying this all the time, right? He continues to buy the top, right? Which implies he's fairly price agnostic. He doesn't really care about the price, right? He's publicly said that he wants to accumulate as much Bitcoin as possible. Of course, with the vision at some point to transition to a kind of financial intermediary, right? To transition to a kind of bank. Because I think his vision is supply on exchanges will be depleted at some point or will become like marginal. There won't be much liquid supply on exchanges anymore, right? Probably they will trade OTC, but Bitcoin will become much, much, much more scarce, right? And so in the future, there will be a need to provide Bitcoin liquidity because there won't be so much supply anymore. And I think in this context, you have to regard his strategy, pun intended, to acquire as much Bitcoin as possible because eventually he'll be that pool of Bitcoin supply that he can lend out or do whatever, at least provide supply, right? Much needed supply, right? I think if you look at the latest data from Glassnode, you only have around 3 million Bitcoins left on exchanges, which is around, I think, 15%. So, and if you assume institutional adoption to accelerate, right, because of this exponential growth phase, the mainstream era, golden era, whatever you want to call this, right, is I think exchanges will likely not like have no supply because always higher prices will induce more supply on exchanges, right? There's always some kind of cycle, but I think we will transition really fast into an environment, especially towards the end of the decade, where like minor exchanges will have trouble providing or attracting supply on exchanges. Maybe Coinbase, Binance, they won't have so much trouble because they're also going into partnerships with liquidity providers and so on, right? They're already seeing this kind of trend and they have like institutional custody business and whatnot. But I think minor exchanges, they will have increasing trouble to provide Bitcoin liquidity.
And that will cause that phase shift, right? That will cause that
Yes.
big jump that we're thinking about here. Going off on Saylor, he recently doubled the 21-21 plan to a 42-42 plan, right? So he's essentially exhausted the ATM purchases of selling equity to buy more Bitcoin, but he still has a fat chunk of those convertible notes to sell, right? So could you explain that to our audience? Does that mean that the debt market isn't there yet? There isn't as much appetite for that? Or is he just going the easy way and selling equity because he can do that very easily on the markets, and it seems as if the shareholders will just grin and bear it as they get diluted?
I can't look into Michael Saylor's head, but like, I think what he's thinking right now is, if you look at bond yields in general, they're quite high, right? And because of increasing recession risks, spreads have also increased. So corporate yields are even a bit higher, right? So maybe he's waiting for a recession or something, right? Recessionary environment where you have like lower bond yields in general, and like corporate spreads coming down, which also implies lower yields for his convertible bonds, right? And that would probably be a better timing than now. We have like US 10-year yields still way above 4%, right? That's probably one of the key reasons why he has been refraining from like selling convertible notes and rather issuing common stocks and so on. Because I mean, the market environment for MicroStrategy common stocks still very much favorable, right? I mean, in terms of market beta, right? I mean, we had this kind of market correction in April in major US equity indices, but still, I mean, we're not too far away from all-time highs, right? And so, like, from equity point of view, I think valuations are still elevated, and if you're like a corporate treasurer, or like if you run a business, you want to sell at close to all-time high, right? You want to sell new shares at close to all-time high, like the highest valuation possible, right? And so I think because bond yields, they behave inversely to bond prices. Bond prices are not like at all-time highs, right? They're quite depressed. If you look at long-term US Treasury bond prices, they're like in one of the worst, or I think the worst bear market, ever. So bond markets are pretty beaten down, but at the same time, I think equity markets are still benign, and that's why he's probably rather selling equity than selling convertible notes.
No, that makes a lot of sense. And as a fellow Bitcoiner, you know that like every few months there's a new chart, that sort of takes the mimetic real estate in a lot of people's heads. And right now it is the Bitcoin versus M2 chart. And so if you offset M2 by 90 days, it lines up almost perfectly, at least it looks like it, on all these charts. So do you put much weight into that? Do you think that's real, or is that just a coincidence?
Maybe it's a coincidence, but I think there are many reasons why it makes sense, at least, right? I think Raoul Pal has been calling this kind of phenomenon the everything code, right? Eventually, everything is determined by the level of liquidity, right? And it makes sense, right? Because Bitcoin is the scarcest asset, right? Major asset, right? And so it's supposed to be the best barometer of liquidity as the scarcest asset. So it totally makes sense that there's some kind of correlation or sensitivity towards global money supply. I think many critics, they have dismissed this, like they said, like, okay, this new all-time high in global money supply, it's just a technicality because like it's so much dependent on the dollar, right? Because foreign money supplies, they're denominated in dollar, right? And because if the dollar dumps, these foreign money supplies increase, right? And so they dismiss this as technicality, but if you listen to guys like Steve Hank, right? He's a libertarian, I think, and he's been coming up with this kind of purchasing power theorem. It applies mostly to hyperinflation and to high inflation countries in general. But the purchasing power theorem states that the currency depreciation is ultimately almost synonymous with inflation, right? Over the long term. So that means if you have, in the extreme case, of course, if you have a significant depreciation of the dollar, right, it actually means that you have a money supply expansion and that you have like true inflation, right, in the monetarist sense of the word, right? Like money supply expansion meaning, inflation. And so I think there's more to it. People dismiss this as a technicality, and they say like, okay, global money supply has reached a new all-time high because the dollar's dumping, right? But I think if you look at the research, and let's say you disregard like the global money supply signal, right? And you say, and you just look at like Bitcoin's correlation to the dollar, right? It's also inversely correlated. It totally makes sense, right? Because I mean, the denominator for Bitcoin's price is the dollar, it's other fiat currencies, right? And if they depreciate, it totally makes sense for Bitcoin to go up, of course, in fiat terms, right? But also, there's also an interesting phenomenon which I call the Bitcoin dollar smirk. Smirk because it's only one-sided, right? Because what you see in the data is, okay, Bitcoin and the dollar is like inversely correlated, right? If the dollar goes up, Bitcoin goes down, and vice versa. If the dollar goes down, Bitcoin goes up, right? The DXY, the dollar index. So totally makes sense, inversely correlated. But like the correlation is not really strong, right? It's like rather weak, sometimes even positively correlated. But I think the interesting bit is at the extremes, right? What we found out is if you look at the worst 20% dollar performance, like the 1/5 worst dollar performance historically, and then plot Bitcoin's performance against it, Bitcoin has actually performed best in these kind of environments, right? By far, like significantly above average, like in environments where the dollar dumped like the worst, right? And in between, like in the 60% of observations in the middle, Bitcoin rather performed on average, right? More or less, but mostly on average. So it's not so much influenced by the dollar. On the other extreme, like the 20% highest appreciations of the dollar, where the dollar performed best, right? You actually see the worst Bitcoin performance, right? So there's this kind of smirk, and I think we saw that in April as well, when foreigners, who knows if it was like Chinese dumping treasuries or like in general foreigners sold US assets, right, the US dollar, and you saw this extreme dump in the DXY, in the dollar index, despite a risk-off move, right? And suddenly we saw this decoupling between like Bitcoin equities, and there was like significant turmoil, not only like in the dollar, but also US assets in general, right? US treasury yields spiked, right? The dollar dumped, which is so unusual during a like risk-off move, like a flight to safety. So unusual, and I think that it goes a long way in explaining this outperformance of Bitcoin during this period, right? Yeah, we call it the dollar smirk, and what we also found out was if you look at different asset classes, right, and different assets, and their sensitivity, their market beta to the dollar, right? For instance, gold. I think across different kinds of observation periods, gold has a market beta to the dollar index of close to 1, right? It makes sense. Like gold goes up almost in the same way the dollar goes down, right? And vice versa. Totally makes sense. It's like a fiat mirror, right? But what we also found out, even if you look at emerging market equities, which are supposed to be very dollar sensitive, right? S&P 500 or other assets, Bitcoin has the highest negative sensitivity, meaning it's around minus 1.5 or 1.6 since COVID, right? So that means for every 1% drop in the dollar, in the DXY, Bitcoin has gone up by 1.5, 1.6%. So, and gold only by 1%, right? So it appears to be a better hedge against not only like de-dollarization, which is like a slow structural trend, right? Slow decline in the dollar, but also against these like sharp moves in the dollar, sharp depreciations, when you have this kind of dollar smirk, you know.
Mm. And in speaking of M2 and money supply, I mean, the man behind the meme himself, Jerome Powell, we've got Trump calling for him to be fired, right? Calling him a loser, that he should cut rates. And as somebody who studies the markets and has been in the markets as long as Jerome has been running the Fed, what do you think of his performance, especially as a European rather than as an American? Do you think that Bitcoiners think that he's just the face of the Fed and, of course, the money printer, and is a bad guy because of that. But from a more objective point of view, how would you grade his performance as leading the U.S. Federal Reserve?
I think he's been constantly behind the curve, right? I don't know whether you remember, but like after COVID, like in 2021, when Bitcoiners were screaming, okay, we will have a huge increase in inflation because of money supply expansion, the Fed was actually slow to increase rates, right? They were very lagging, right? So they were behind the curve in increasing rates. Right? But now that like inflation is coming down, unemployment's probably increasing, the unemployment rate, they're slow to cut rates again. Right? We're in a kind of recessionary environment, right? I mean, obviously, Q1, it's official numbers, right? Q1 2025, US GDP growth has already contracted, right? Right. So we're in a kind of recessionary, contractionary environment, right? And they're still pausing rate cuts, right? And if you look at like things like the Taylor rule, which is a very simple monetary policy rule, which just consists of essentially core inflation and the unemployment rate, already implies like the Fed funds target rate should be at least 75 basis points lower, right? So the Fed is again behind the curve, right? It could explain the reason why we're still seeing these high bond yields as well, right? Because like then there's not much effort from the Fed itself. At least they're not communicating to the market that they will cut rates aggressively or anything. To the contrary, it still looks like they're just waiting. They're in a kind of wait and see mode. They want to see even worse data. I don't know. But it appears to be the case that they're looking at lagging economic data, which is somewhat concerning, right? Because like every business cycle analyst, I mean, it makes sense to look at leading indicators, and they don't look rosy, right? If you look even at the Conference Board leading economic index, right? It's below COVID lows, right? It's already in a kind of recessionary environment. It's, below COVID lows. And the reason is, of course, it's not only related to the trade policies, right, and the trade conflict. It's mostly related to the lagging effects of the previous tightening, Fed monetary policy tightening, the previous rate increase, which tends to like feed into the housing market with a like significant lag, right? You can already see like housing is very weak, right? Housing, like even rent inflation is coming down and so on, all these indicators. You see all these posts like, Miami housing market or anything like regional housing market is so bad, like inventory is going up. Almost every week I see new listings, right? Like this anecdotal evidence, but you can already see it in the data, like all kinds of survey data, existing home sales, pending home sales, they're super weak, right? And so these indicators tend to be leading like the overall business cycle. The housing market's one of the most leading indicators, right? And so I think the necessary conditions for recession were already in place because of Fed tightening, the previous Fed tightening that we saw. And now the trade policies, the trade conflict, they were just this kind of catalyst, this exogenous shock, right? As a kind of sufficient conditions for a recession. And I think the Fed's behind the curve, right? The Fed's behind the curve, not only based on the Taylor rule, but if you look at these leading indicators like survey-based manufacturing indices, like Centix, like these investor surveys, they're really at subprime levels, right? They're approaching subprime or COVID levels. So I think, let's see. I think the probability of recession is quite high. It's definitely higher than 50%. And if you look at Polymarket, same kind of message, right? I think the recession probabilities are above 50%. So it's quite likely that we are already in a recession right now. I mean, Q1 was already negative, and Q2 will probably or most likely also be negative. So I think the Fed's still behind the curve, right?
Mm. Yeah, and you recently gave a talk about what if the dollar isn't forever, right? And so if you've got a $1 million price target for Bitcoin within 4 years, and de-dollarization seems to be right in front of our faces, it's no longer just a talking point, but something that we're seeing play out in the headlines and in trade deals. How do you see the rest of the 2020s playing out in terms of hyper-Bitcoinization, the dollar, and what it means for the average person living in Europe or America?
I think the mega trends you're seeing is, apart from Bitcoin, of course, right? I mean, Bitcoin adoption will probably accelerate, right? That in itself will lead to higher prices, right? Like if you look at institutional adoption, corporate adoption, ETF adoption, investor adoption more broadly, right? Financial advisors and so on. So that will definitely increase, probably even exponentially, right? At some point. Might be too bullish, but I think there's much evidence that points towards this. But I think, like, apart from this Bitcoin trend, I think the general trend right now is de-dollarization, right? As you mentioned, probably deglobalization, right? Because essentially, if like the Trump administration hikes tariffs that aggressively, I mean, they've just revised tariffs back to, I think, 10 or 15%, but still, I mean, there's only 90-day truce. And so if you assume that, like, there will always be some kind of trade feud between the US and China, you'll probably have some deglobalization, because most of the trade happens between US and China, right? It's like 20% of world trade or even more, right? And so, that's the mega trend. It also implies de-dollarization, right? And this has been happening, I think, since the 1990s, right? It's like a structural trend. It doesn't happen overnight, right? We used to have a percentage of around 71% of the dollar in international FX reserves. It's close to 57%. So that has been declining, right? That's definitely a mega trend. It implies, if we have like more aggressive dollar depreciations, that commodity prices will move up at some point, especially if we have like a new business cycle uptrend. Like if we assume, okay, we're now in a contractionary phase, we're at the trough of the business cycle, it implies so we'll have an expansion over the next couple of years, right? So that will probably increase commodity prices, and if you have a declining dollar, even more so, right? And we have like internal quantitative models that point towards this, that we'll move towards 5% again next year in terms of inflation, right? Because if you have like a new commodities upcycle, new business cycle upswing, and a dollar depreciation, I think so high inflation will prevail, right? It probably will come down temporarily because of recession. And if you look at these trueflation high frequency indicators, they also imply, okay, that we don't have like huge inflation pressure. But because of deglobalization, de-dollarization, increasing trade tensions, hike in tariffs, which I think are definitely inflationary, there's no doubt about it, because of import price inflation. It's just a technical fact, right? You'll see that inflation will come down temporarily in the short term, but over the medium to long term, you'll probably face a high inflation period, which is supposed to be good for Bitcoin, right? It's supposed to be good for, scarce assets, gold, Bitcoin. And so I think this need for investors, retail, institutional investors, to hedge against like high inflation, this will also prevail, right, over the coming years, you know.
Sounds like people need some Bitcoin.
Yes.
Yes, better get some in case it catches on. Well, yeah, Andre, we're coming up on our time here. I want to thank you very much for sitting down and talking with us. If people want to find out more about you and Bitwise, where can they go?
So you'll find me on Twitter. My Twitter handle is at Andre_Dragosch, or you find me on LinkedIn.
Nice. Highly recommend following you on Twitter. You've got great charts, great data coming out on a daily basis. And we at Bitcoin News love to share those. So thank you very much, and we'll definitely have you on again in the future.
Thank you so much, Rob. Really enjoyed it. Thank you.